All right, start recording. What time is it? 12:02. So, to start, I kind of wanted to go over. I was gonna go over some of my trades, maybe. Bit of a losing streak this week for me. A couple losses in a row, and then the only trade that I have active right now is Euro Chef. I just got tapped into this today, and then it was a loss on these three pairs here. So I had NZD USD, a buy position, which we could fairly clearly see, liquidity sweep here, break a structure, fair value gap, and just really focused on that range high to range low. AUD USD, definitely a little bit more aggressive than my usual position, but almost an identical idea to the other two, where we had a clear sweep on liquidity here, a break of structure in a fair value gap in the range, another one. So that was a -1 as well, and then AUD JPY. Same kind of idea. This one was counter to the trend overall, though. We had a great sweep on liquidity, very impulsive, a large fair value gap, break a structure, and then it does inevitably run that stop loss as well. So let me move this over here just so I can keep up. Actually, we are probably going to do some data reviews today. I want to get around to some of those, but just kind of briefly show you guys my trades I've taken, and then Euro Chef is what I'm currently in. Towards the end of the webinar, if we have some time, you guys can share me any setups that you guys want, and we can go through them. I got rid of my TradingView whatever subscription because I realized I barely use it. It was mainly when I was on the lower time frames, I would use different time frames and stuff like that. I haven't traded lower time frame in years, and I've had the subscription ever since. I don't really have much of a use for it, and I think that it saved my ability to have multiple watch lists anyways. So because I had the format saved where I had my two watch lists and different time frames and stuff like that, it saved it. So I guess I get to hold on to this for as long as I don't delete this watch list. I can keep both of mine. This one here I don't use too much either. It's mainly just I like to look at different currencies and assets. So I like gold, silver, Bitcoin, Ethereum, S&P 500, US 30. So it's kind of just a watch list to keep up with stuff outside of Forex. But I don't really trade it or anything actively. But I just thought it was cool. I got rid of my subscription and got to hold on to that. And then I think, even sessions, I used to use the sessions indicator a lot. I think I'm allowed like one indicator per chart, but because once again I had it saved, this layout, it's going to let me hold on to it, it seems like. Let's look at chat. Not in GJ. Probably not. I know the last few days I have not been trading much. For GJ, I'm assuming the short is what you're referring to. I actually never took that short. I took USD JPY and then Chef JPY were the two that I had my orders on. Chef was a close miss here. I never got tagged in on my broker. So this one to this one. And then USD JPY was my winning position from last week. So yeah, I never actually took GJ. It was just not something that really stood out to me as much as the other pairs as well. But yeah, I know some people have been complaining about swap and whatnot in that pair, which I can understand, especially on GJ, is probably brutal. If it starts eating into your account too much, I would close that out, honestly. I would not hold a trade for too long. But let's go ahead here, and I want to do some data reviews today. We'll go through here. First come, first serve as always. So let me just start down here. It should be this one here. 2022 data review. So this is 106 trades on different pairs in 2022. Somehow plus or minus 0 because of a win streak at the end. And a few things I'll mention before popping this open. He's fairly new to the server. This is one of his first testing sessions. So yes, it can be expected that the data is not going to be over the top or perfect on your first run through. It's perfectly normal. So I would not get discouraged on your first set of testing. That's something I always like to throw out there. Because, funny enough story, me and Andre, when we first were testing 4-hour time frames and different strategies and adjustments to it, we had like a 0% win rate for weeks. I remember being on a camping trip and, we were messaging back and forth, just different ideas about 4-hour swing trading, what we can kind of do, how we should operate it and whatnot. And I remember just being on a camping trip and every set of testing he would send me was like 0% win rate. I remember before heading away for the weekend, we were testing a bunch, just 0% win rate as well. So yeah, I mean, definitely don't be too hard on yourself for your first set of testing with the strategy, because at the end of the day, trading is pattern recognition based. And found a problem. That's odd. Let's see what we can do here. All right, looks fine to me. But yeah, at the end of the day, trading is pattern recognition based and conditional formatting. That's why. That's odd. I use conditional formatting in my own journal. But just the ability to see trade patterns and get used to them in general is something that's going to take time. Let me. Okay, so it looks like the formatting was. Sounds like someone's peeing right now. Let me let me server mute just real quick. I don't know if they want their mic to be on or not. But let's take a look at the equity curve here, which I like that you mapped it out for me. One of the first things I kind of look at, so you can see right away, you're going to see that kind of negative drawdown period and obviously a crazy win streak at the end here. So we're going to go over that. And then the conditional formatting, I'm not quite sure why. It looks like the trades, that is a bit odd. These should be, yeah, that's odd. I don't know why it, oh, you know why? It's because this needs to be left aligned, and then we'll drop this again. There we go. So, and then let me close this up too, because there's not many comments here, just so I can see the full data in one picture. Losses, wins. So just an overview to start. Win-loss ratio being 52.34 is pretty solid here. E2 plus F2. So that should be sum of your wins, which is equal to 0. So that's including break even, which is not bad actually. So it's fairly a little bit lower than typical. 56 wins and 51 losses. Typically, I find with break even, somewhere around that 55 to 61 level, in that general range, 58 to 61 is where I find the break even included win rate falls. So a little bit lower on that end. But what I'm going to do here actually is delete the equals to get an idea. And so this is where the reality of the data is shown a little bit more clearly, with a 25% win rate instead of a 35 or so that we tend to look for. Let me look in chat. I don't know what happened. No, it's fine. I mean, fix it up pretty quickly there. And then, yeah, so 25 is definitely lower than we typically like to look for. But once again, like I said, your first set of testing, I don't think it's bad at all. If this tells me anything, though, and it's a fairly common occurrence, if someone has a decent or a relatively high win rate utilizing break even, but has a significantly lower win rate using just wins and losses and negating the break-even statistics, this tells me typically it is a case of missed winning trades more than it is bad losers. Now, it can also be a mix of both, keep in mind, but if there's a case of missing winning trades, it does come down to that pattern recognition I talked about, where just with time and experience, you're going to get used to seeing the trades more. And it is one of those things that's tough when going over data. You can't necessarily see the trades that they may have missed. So we're going to go through that first. Hold on, let me mute mics just in case people don't mean to be unmuted or not. Let me keep this open over here for now, just so I can look at chat as we go. And let's start here. So I'm going to drag this over. This right away, it's not the cleanest trading range I've seen. I like the structure that you're marking out here, so the lower lows and lower highs. But I do like the fair value gap, and the most recent break of structure you're using here is pretty solid. One thing I like to always do is you want to focus on the range that you're looking at regarding where you mark your sweeps and where you mark your breaks of structure. So it's definitely a little bit of significantly zoomed in price action here, but what I mean by that is if I draw my break of structure at this low that got broken, the highest point that broke that low is where my fib should be set. Now, I'm not necessarily saying that means it's a valid trade in this scenario, but what I am saying is you want to be marking your structure, your liquidity sweeps, and fair value gaps based on the range that you're looking at. So for me, if this were the range high and the range low that you used, you would want to have your break of structure marked here because that's the highest point that broke structure to create the range that you're looking at. Let's take a look here at some other trades. This one's great in my opinion. So kind of like what we just talked about, this is your highest point that broke that low. So you have your break of structure marked up fairly well there. My other recommendation, before even diving into other trades, is definitely mark your liquidity sweep and your fair value gaps on all your trades as well, because I find that just simply doing that kind of helps you get in the habit of looking for every rule in the checklists, even subconsciously, because some people get in the habit of not marking it up, and then it leads to them, it leads to them kind of forgetting some of the rules in between. Yeah, most I haven't marked anything. Yeah, I mean, it's just like a small, like, I would still say it's a great trade regardless, the one we just looked at, but I think it's like a small detail that does help with the pattern recognition of things. This is a great trade as well, great break-even trade. I like it's our most recent break of structure here. There is a liquidity sweep down the bottom, fair value gap around the entry. Nothing wrong with that setup. This one as well, sometimes I like, to establish trend if we are going to go counter to the trend like this, because it does look fairly bearish, but I like the liquidity sweep here, the break of structure, huge fair value gap, so another solid break-even trade there in my opinion. Let's see. This one's nice as well. I do think it's tougher when operating with these, not only these very odd high volume candles, but when I see it's almost like a general range created here at the high, I tend to look for the liquidity sweep for that reason in most cases, or if not that, trying to avoid places where there's a lot of equal highs resting. So there's this high, this one, this one, this one, and this one, all kind of resting in that same level. And just based on what we know about liquidity, more likely than not, the markets are going to go and target some very sideways or consolidating areas like this. If this wick were to have come and taken out all of the highs here, and even this one, I definitely think it would be higher probability because we saw the liquidity purge happen. However, despite this being a high volume wick, it never really came to take out some of these more significant highs in price here. So later in the future, we can expect that liquidity is going to be targeted in those areas. It's a great trade as well. Nothing wrong with that one. Another solid one. Sometimes, maybe a little bit of a better break of structure could be nice to see in situations like this. I like the sweep on liquidity here. I know the rule is the candle close rule. That's one thing that even myself, I get asked about, whether there's an AUD pair that I got asked about. Let me see if I can find it. This one. So despite it having a candle close, if I look at something and price just wicks the high and then very aggressively tanks downward, it's showing me that institutional involvement, that clearly we swept liquidity here with a very high volume and impulsive move, and then moved and broke structure, or at least shifted bearishly with a very strong and impulsive move the other direction. These two indicators typically show me a sweep over a break of structure. It's kind of why, despite it being a little bit of a candle close above in this scenario, if I see two very strong and high volume candles at a higher low, more likely than not, I see it as a sweep and not a break. It was actually kind of a similar scenario on USD Chef a few weeks ago, where, some people were asking me why I did not see this as a break of structure. Same kind of idea, a very aggressive wick right below it, and then a very strong break or movement up right after. These are very clear, and liquidity sweeps I guess they're just very clear liquidity sweeps in general, and something that I would avoid trying to market structure. So this one's not bad, but I do think this is an area where if we keep going on and I see more of these positions, it could be something that hurts the win rate fairly significantly for a few reasons. Number one, I talk about range-based trading a lot, and the idea of trading a range. What I mean by that is if price action is moving upward, and then we break structure to the upside, this to me from the low to the high is a trading range, because a lot of the time if I take my fib and draw it, a rule you guys might hear me talk about is if this 50% is way above this high here, it starts, becoming a little bit goofy and something that I don't necessarily like to trade, because it's overextended. So I would much rather trade a range like this than a range like this, for example, where it's simply a supply or demand, some people might call it, or an order block, and it's a very small and minuscule retracement in price action, and using that as a break. So these types of trades that we were just looking at here, I would try to avoid these. It's a very small and minuscule movement in price with a huge movement downward. And at any point, if this becomes too extended, for me, if the 50% passes the break of structure, it's kind of a little soft rule I have in some cases. In this case, you can even see the entry is significantly past the break of structure. So I would definitely avoid these kinds of trades. And in the longer term, you'll find that just that may help your data fairly significantly. This is a good trade too. Not a bad one overall. It's kind of similar to what I was just talking about, but not as exaggerative. So I do think this is still a solid setup. We do have some equal highs here resting though. Again, triple equal highs in that scenario. This one's not bad. I like that it's the most recent break of structure here. I like the volume at entry. We have a fair value gap there. And just kind of following that bullish trend. So that's a solid setup in my opinion. This one as well kind of falls into that category of using a consolidation area for your low or high. So based on what we know and learned about liquidity, in these consolidation areas is where a lot of liquidity in the markets rests. And, for the very beginner basic explanation of it, if the market is consolidating very low and slow like this in this range, from the date of the 27th all the way up to, we'll call it August 1st, price had nowhere to place orders except for below this low or above this high, meaning that within that time period of about a week, nobody could place any orders lower than this and higher than this. So what you'll find is that, let's see if I can grab like a drawing tool here. So from this low to this high is where, that was a terrible drawing, but is where all the orders in the market rest within that period of time. And obviously your low almost ties into that relatively as an equal low. So what you'll find is that instead of this low ending up holding with the break of structure and whatnot, all the liquidity was targeted at the very low of that to then go and probably drive price in your intended direction after. So I would not be surprised to see if this trade ended up running take profit after this. But just from that standpoint of using a consolidation area as your overall stop loss, I really try to avoid that. Try to avoid equal lows if you can, because as you can see, the markets, very intentionally went and took out all the liquidity of this range with a nice sharp wick and then drove price the other way right after. So focusing on where your stop loss lies and having a good solid sweep or high volume area compared to, what's going on back here with this consolidation. I think that is, there we go. This one's not bad. It does kind of have relative equal lows as well, but I do like the break of structure here, and I like the size of the range. We have equal lows here, basically, that got taken out, and then price runs higher. So not a bad setup there. This one's kind of in a similar scenario where it's your stop loss is resting at a consolidation area as opposed to a nice area that sweeps some liquidity. Because as we can see, there's a lot of just sideways price action here, and with the stop loss in that area, you're more likely than not going to see these wicks right through your stop loss and then a strong reaction after that, because it's using your stop loss as liquidity essentially. An old saying too I used to hear was if you don't see a sweep of liquidity, you are the sweep of liquidity. It's kind of what we're seeing in this case, where neglecting the the high volume sweeps or the good trending markets, you will find your stop loss getting swept fairly often and then moving in that intended direction. This one here is not bad, but it does come down to what I talked about before about the ranges. So wherever your stop loss is where your break of structure should be marked up. And in this case, if I draw this out here, with your stop loss being here, technically that means that this is the break of structure you're using, and I just don't think that's significant enough for a range to trade. So this is a position I would personally avoid. But I see the general idea here too. We have the fair value gap, we have a sweep here at the high, and all of the other rules met, but I definitely want to see those more range-based trades being taken compared to what I talked about before with like that very little Hampus said he stopped taking those trades, almost always losing. So I agree. This is not necessarily something that for me fits the trading plan, because like I said, I see a lot of people trying to take stuff like this, and it almost reverts to the idea of supply and demand and order blocks, which is not really, fundamentally what the goal of this trading plan is. It's mostly range-based trading, which a trading range is something more like this, compared to trying to take something like this, which, yes, fundamentally in smart money, some people might call that an order block, a supply zone, a demand zone, but based on the way that we trade and what I've found works better, it's best to avoid these kinds of very small ranges or areas of price. Let's close some of these tabs so we don't get too caught up here. Let's keep going a little bit. This one's not bad. Once again, it kind of, oops, clicked on an ad. Once again, it kind of goes back to what I talked about with the stop loss being at a very low quality, high or low in price action. Like you'll notice in my trades that I do take, I like my stop loss being at an area that's, you know, very impulsive, high volume, grabbed a piece of liquidity. Once again, very impulsive and high volume. We have this very high volume bearish candle with the wick, and then a very high volume bullish candle. Euro Chef, kind of same idea where there's consolidation here, but after the consolidation, we see that very high volume sweep up and then a very high volume breakdown. I say very high volume 50 times in a row, it probably gets annoying, but some people, you know, you got to fundamentally remember that this trading plan is based on institutional involvement, and your goal is to better align yourself with institutional positions in the market. And those very high volume sweeps and high volume breaks is what shows that and kind of gives us the indication that institutionally or large hands, smart money, whatever you want to call it, is more likely on that bearish side in the market. Even despite this being a little bit more of an aggressive trade than I'm used to taking too, but for me, it fit the fib rule, which is, you know, seeing that 50 of the fib a little bit below that break of structure. I was fine with taking it. Let's see here. Not a bad one either. You know, still kind of lacking that impulsive sweep, but I think, you know, I like it because it's the most recent break of structure in price action. There was definitely some consolidation around here at the high, which makes it a little bit of an iffy range, but overall not bad. Let's delete some more of these. Same kind of idea. You know, a bit of a weaker stop loss here, but I like the fair value gap around entry, and I like that it's the most recent break of structure. You know, you'll hear me say that term a lot, but focusing on the higher highs and higher lows in the market and the most recent break of structure, you're going to have the best strike rate with something like that. Not bad as well. So a lot of these do kind of fall into that category I talked about with a lower quality stop loss. So stop loss placement is very important in this strategy because it's obviously fixed with the Fibonacci tool. So you want to make sure that you're taking the highest quality lows or highs in the market and having your stop loss rest at a good place, because kind of like we talked about before, if you don't see the sweep of liquidity, you likely are the sweep of liquidity. And we're seeing that here where there's some consolidation in price action, not really a significant sweep of liquidity or a high volume low, and then price ends up coming and sweeping that area and then seeing this very high volume movement to the upside. Not a bad trade here, definitely a little bit better regarding the volume, so I like how high volume the bearish candle and the bullish candle are. Great break of structure, fair value gaps. This is a better trade here in my opinion. Not sure if it was a break even or a loss, but regardless, looks like a loss here. But once again, not bad. But it does come down to what we talked about the ranges. So we'll grab that snip tool again. I don't know if there's an easier way to draw on your screen. I always use this tool. I love the liquidity sweep here. We see that very high volume bearish candle with a very high volume wick, you know, which I talked about is one of the nicest things I like to see. However, the lowest point that the highest point that broke the most previous low would be this again. And I just don't necessarily find that these types of breaks of structures or weak ranges really work too well. I like to see those larger scale ranges playing out. You could call this your break of structure as well. It's a little bit better, but this wick did come and take that and then make that new high and then make the new low. So this is technically the break of structure you're working with. Not bad again. I like the, oops, I'm going to keep doing that now that I downgraded my trading view. I like the high volume wick once again at the high and then a high volume move out of that. I think one of the key things for me personally is regarding my stop loss, I love to keep them in those high volume areas. So I think this is a great trade just regarding your stop loss being at the highest volume movement. I will say, I would focus a little bit more on the accuracy of your stop loss too. I see that, I thought it was maybe a mistake in drawing when your stop loss is kind of below the candle a little bit. You definitely want to be a little bit more precise because it'll be a pain in the ass. There is going to be trades where if you have your stop loss like this, price will come up and tap that, sweep you out, and then run TP. And if you just had it in the, the area that you're supposed to, which is the very high that breaks the low, you would have been able to stay in the trade. May not be that big of a deal, but, it's a pain in the ass psychologically when in the long term you are going to get taken out of trades for having your stop loss lower than it should be. Let's go down. I'm going to actually skip a little bit towards the bottom here because I know you had that significant win streak. I see it right here in the end, 4 wins in a row, which is very significant. But I just want to make sure I get a big picture of the data because obviously as you go, you're learning more. So once again, I think this is a great example. I love the bearish high volume here, grabbing this liquidity low, and then the very bullish high volume after that. Changed up the candle colors too, which, Sven says that gives you like plus 10%. I can't say there's too much truth to that, but we'll go with it. This kind of goes into the category of the liquidity sweep I talked about, where there is some relative equal lows here once again. So I think just based on kind of what I've gone over so far, my conclusion would be those two main things. Number one is focusing on your trading ranges. So focusing on price action that looks more like this as a range to go and put your fib on compared to a small order block or something in price action and having that as your fib. You really want to focus on these types of clear ranges in price action compared to those. That'll definitely be a big improvement on strike rate, is trying to leave out some of these scenarios. And then the other thing I would say is really focusing on your stop loss placement. If price action, came down and looked a little something kind of like this, and then broke structure higher, yes, despite it breaking structure, I would say this does not follow that liquidity sweep rule or the high volume low or high. What's going on, SK? Compared to, so sorry, I lost my train of thought there, but from the high to the low, that would be your entry. I would avoid trades like this as much as you can because that consolidation at the end of the day is a pool of liquidity compared to if this final candle here grabbed the liquidity and then moved up, I would be more than happy to go and take this trade from this low to this high. So you really want to focus on that sweep or that impulsiveness at the low or high of ranges. And you definitely want to focus on more range-based trading compared to trying to take trades with essentially just kind of like an order block or a tiny little retracement. And if you want a more mechanical way to measure it, I personally, this 50% line that I have here, if it goes above my break of structure, I tend to avoid those trades. And especially on some of yours, I've seen that even the entry, we're going to have to zoom out a lot here, but even the entry seems to go above your break of structure. In cases like this, I would definitely avoid those trades and consider the range to be far overextended at that point. I think overall, though, some of the winners I've seen look good. Let's look at the win streak here. I'm just curious. So yeah, I think it's a great setup. Break of structure, large fair value gap in here. Very close to stop loss, but does end up making that run to TP. I like to sweep on liquidity. We have some relative equals, a nice impulsive wick above it, and then a break lower. This one, I would say, is not the cleanest trade despite it winning. And yes, sometimes it can work. This kind of goes back to what we talked about with the break of structure. In this scenario, actually, I would argue that there isn't a break of structure at all. Because kind of what we talked about is if your stop loss is at a higher low, that is where your break of structure should have presented itself. And realistically, we're almost looking at like a one candle break of structure or one that didn't occur here. So I would avoid this despite the outcome of it. I would be avoiding these types of trades. That is another important factor to some of you that may hindsight trade. If this trade were to play out and then after the fact you go and look and say, oh, this order block is, or this supply zone is what worked, I'm going to start taking more trades like this. Be wary of hindsight trading. It can send you down a tunnel of trades that are not necessarily the best to be taking for your edge. It's kind of what I talked about in chat today where Vanlith had a question regarding these two setups. and he sent this after, which you can clearly see this order block type zone did kind of have a reaction to it. Obviously, it went sideways after, and he was asking about that versus the sell. To me, the sell is very clear. We have the sweep, we have the break, the high volume break, the high volume candle at the high. Great sell setup here. But because the buy setup might have reacted to it and had a better reaction, he gets confused on what he should have taken. Avoid the hindsight trading. Avoid looking at what happened and then saying, what should I have done? If I were to cut this right half of the screen off, you should be able to very clearly see your entry plan and your entry model. And this is what's going to help you get better in a live market as well, is being able to avoid hindsight, which means, going back and seeing, okay, which one played better, and that's what I should be doing. You want to avoid that, and you want to just focus on, okay, what follows my rules, and whatever happens after is simply just market noise, and part of the randomness of the market, and you want to see if you have an edge with that entry model longer term. See some of these other winners here. This one's not bad as well, but I would say it does not necessarily follow that break of structure rule with the wick of the high. But other than that, it's not bad. I like the fair value gap here. I like the low and the high of the range. And then we have one more here we'll take a look at. This one as well is not bad. I would say it lacks a liquidity sweep a little bit, but other than that, looks pretty solid. So I think those would be my two main takeaways. I kind of briefly went over them. I'll mention them one more time, but focusing on a high quality, low or high for your stop loss. So, in my scenario here, I have a very impulsive and high volume sweep on liquidity with this strong blue candle, and then a very strong break of structure with these two very large and impulsive candles. Keeping my stop loss at an area like that ensures it's a little bit more protected than having it at a consolidation area. For example, if price action didn't do this sweep and just kind of broke down and I had my stop loss here, you can see I would have gotten swept out aggressively, and then price would have moved in my intended direction without me. So that is something common that I tend to look for. That term I talked about where if you don't see a sweep, if you don't see liquidity, you are the liquidity. What was the trend? I don't focus on trend line liquidity. Trend line liquidity, in my opinion, is something that I cannot stand because, number one, the markets don't move diagonally from a order-based standpoint. Candlestick charts is not something that institutions even look at. So institutions look at simply an order book, buys, sell positions in the market, what has significance, more buy orders or more sell orders. When an institution looks at price action, it's horizontal lines based on price and what price people are buying or selling a currency at. You can draw a trend line for almost any, I could pull up any chart and make a trend line almost anywhere I want. Trend line here, trend line there, trend line there. There was one here, one this way, a channel or whatever you call it, some here. I could then zoom out and draw like a bigger one like this. That was a little bit of an arc, but draw one like this, draw one like this. They're everywhere at the end of the day, no matter how you look at price. I really, really try to avoid that because in my opinion, it is the most discretionary way to look at price is trend lines. I think it's super, super discretionary, even worse in indicators. So try to avoid trend lines. That was a huge thing I had to learn when working in the retail space as well, is trend line liquidity is just very, very discretionary. It can be drawn almost any way you want on a chart. And even if price, if price started coming up and took my stop loss and then ran, I could now draw a new trend line from these three highs and, call that liquidity now. It's just one of those things that can be very discretionary. So I try to avoid that. But back to the takeaways I was mentioning is, one, just really focusing on that high quality stop loss at your lows and highs, making sure that you're in a solid area and an impulsive low or high. And then the other one is focusing on those trading ranges where we see a good break of structure like this compared to a trading range where it's a very small order block. This goes back to what I talked about where I would mark your break of structure, your sweep, and your fair value gap on every trade. And as you do that more and more, you may find that some of these setups like this, there really is no break of structure to mark. So, I wouldn't be able to mark a break of structure here with this being my high, because your break of structure should always stem from the highest point that breaks a low, or your stop loss, I mean. So there wasn't really one present in this scenario. I think that's why it's important to mark it on every single trade. But overall, not bad. It's a good start for the data. I think those two things alone would significantly improve your win rate. So I would try that out and then maybe go through another session of testing here. Let's close this one out. Don't save. Let me make sure I don't have any questions. All right, perfect. So I'm glad we went over that one. We will now go over, let's see here. Let me check that one off. VMN. So VMN, before going into this, I do want to say one thing. He has been very, very adamant about his data not looking as good as he would like. I do want to encourage a lot of you guys, focus on, maybe even look at the coach's data, maybe even try to step back from, social media and certain expectations you may have on the market. I see data like this, and there is not a concern in the world for me. What I see right here is a money printer at the end of the day. You're looking at a 35% win rate over 250 trades, the cleanest equity curve I've ever seen. But, he seems to lack the confidence in that edge. Super, super important. Please just be able to, take your data. I wonder if is this a notion we're going to look at? Yeah. But please be able to just have a little bit more realistic expectations in your data. Not to mention, Andre has provided 1,000 trades of backtested data in the simple strategy section here. Maybe compare yours to that. If you lack the confidence in it, understand that someone like Andre has that exact same 35, 36% win rate, but he's able to make money in the markets. So I think that's a big thing, is if your coach or mentor is showing a 35, 36% win rate and has been making money in trading for, I've known Andre for like 5 years now. I think I've known him. And it's one of those things where, you have to be able to compare yourself and say, okay, if they're doing it with the same exact data I am, and I got the same results, why can't I? 99 out of 100 times, 999 out of 1,000 times, it is psychology related or expectation related. Some people want the 40% or the 50% win rate because they feel like it is what it seems like at the end of the day. They just want that higher number, when something like this or this type of data, it clearly prints money in the longer term, regardless of your win rate, focusing on repetitions and, making a 300% gain in the markets. So I'll go over this, but I will say before I dive too deep into it, nothing of concern here. So we'll go over the trades and setups. I'll briefly go through it, but my recommendation before even starting would be exactly what you did in this Notion and in your backtesting session. Replicate that in a live market as much as you can. Collect trade images is a good one. So take all your trade images, put them in a little folder if you want, put them in something that you can look at on your desk maybe. Write out your trading plan and little nuances if that's something you want on your desk. I used to have like a little binder that had my trading plan written in it with some trade images. Obviously, as time went on, I didn't necessarily need it as much anymore. But from a psychology standpoint, just having the images in replicating exactly what you did in this testing session, and you will 100% see profit in the live market. It's all boils down to psychology beyond that point. Let's take a look here. So 35% win rate, 250 trades, just about 76 break even, which leaves you at a realized win rate of about 34.29. It says 60 wins, 15 losses, 75 break even. Long, short, let me just take a look at the data so I can get an understanding. Is there trade images here? I've done this before and someone told me, there we go. All right. So that's a solid setup there. Let me briefly, I just want to get one last overview. Oh, okay. He gave me a little note here. That's good too. So this is the 250th trade. The equity curve looks great. This is over the period of 1 year, it looks like. And how many pairs? 1, 2, 3, 4, 5, 6. So about 10 pairs, it looks like. Trading plan guidelines, structure, require some liquidity, can be very small, require meaningful size of unmitigated imbalance around your entry, focus on impulsiveness, 75. So this is honestly, these number 5s is what I look for at the end of the day. I like to see my structure, of course. I like to require some liquidity, can be very small in some cases, especially if it's like a pro trend trade. I'm fine with that. But you know, for me, this is kind of what I talked about before, where I said having your stop loss at a meaningful area is kind of what I meant. You know, having your stop loss at those higher volume lows or highs in price action alone will help out. It's kind of similar to what he's speaking of here. Meaningful size of imbalance around your entry. I don't typically focus on around my entry, but you know, imbalance that I can spot visually. I like to see that 75 fib. And yes, same thing. So these ones here, don't focus on too small price action. I would agree with that. It's actually kind of what we talked about in the previous review. So prevents you from trading all over the place, missing true trend leading trades. I think that's a great example, or you know, a written rule why. Taken out too often, first reversal trades, mitigates imbalance from trend. News and spread hours takes you, that's very true as well. Those very small stop losses or small ranges, you're going to get taken out a lot more often due to news or spread. And then try to align with swing structure, skip internal trades against swing structure. And then you could take your order off if you feel the imbalance is mitigated, gave a reaction, and still coming for your entry. If you can't identify the setup in 10 seconds, I love that rule right there. Absolutely love that rule. A lot of people could learn from that one. You know, it's something I used to say a lot. If you aren't looking at your chart and see your entry model in 10 seconds, you are overcomplicating, or it's a trade that you should not be taking. Big believer in that one, especially with people who, like him, have tested over 250 trades. You should be able to spot something right away after 250 repetitions. You know, and that goes for many other things in life as well. If you have this much practice in something, things should be no-brainers. It should come to you well. And if it's not, you're more likely than not forcing a trade or setup based on some psychological factor. Maybe you saw it in the Discord and you saw some other people taking it and now you want to take it, or you know, maybe it's a trade that would get you the win on your challenge if you take it and you're nervous about missing it. All these psychological factors, trying to put them aside, you should be able to spot your entry model right away. This trade looks great. I know I already kind of opened this one, but we're pro trend here in this scenario. We have a sweep on liquidity, your most recent break of structure and price action. So that's a solid setup there. We have that impulsive bearish movement for a stop loss at the low. So these two very large bearish candles there. I like to see that. Same kind of idea here. We have the sweep of liquidity on the high and then the break of structure of the low. A little bit of a weaker break of structure here, but we are kind of following that overall trend and good trade regardless. Same thing. I think I took this trade live. I don't even know what pair this, yeah, AU. Actually, I think this pair is, or this trade, if I go to swing structure, then I scroll up. Yeah, it's this one here, right? Sweep on liquidity. Yeah, AUD USD 1010 2023. I think it's the same one there. Let me go back. No, it is a different one, I think. No, it is the same one. I think the date's just logged differently. Either way, looks almost identical, which is kind of the point of it at the end of the day, is that pattern recognition. Great trade there. See here. This one's a little bit iffy for me personally. I don't like to wait too long for my trades to play out. Like if price is just kind of consolidating for this long, but it's not a bad setup. And honestly, you can't really prevent it. In some cases, if you're on a live account and you have that order sitting, you can't really, you know, it's more discretional to say, okay, I've been holding this trade for X amount of time. I'm going to let that be. Looking at it, so like AUDJPY, what setup do you have in Outlook? Sorry, I missed that. What time is it? I want to make sure. Oh, that was a good little while ago. Sorry, I missed that question. Bogdan, I didn't see that. What setup do you have in Outlook? I think you were referring to. Oh, this was a past trade. If this is the one you were referring to, so I had a buy position on AUDJPY. But that's already played out. My only current trade is that Euro Chef one that I kind of went over a little bit before. But these trades look solid. I'm going to actually kind of skip a little bit. I don't want to go straight down the line because I feel like it gives better understanding of the full data set here. So this one would fall under the category I talked about, where having your stop loss at a meaningful area with some good liquidity or high volume. Can I open? Oh, I can open these. There we go. So this kind of falls into that consolidation category we talked about. If this wick were to come and take this overall high right here and then break lower, I would have liked that a lot more because it shows that high volume the impulsiveness of the sweep that we like to see, and the break lower. I think this is not a bad trade regardless. I like the mapping of structure here too. He's doing a great job showing the higher highs and lower lows and lower highs. But I do think having your stop loss at a little bit more of that meaningful area with a strong sweep and break. How do I get out of here now? There we go. Let's go a little lower. Another solid setup here. I don't see anything wrong with this. The consolidation area, once again, now here's a difference I want to point out. Notice how there's consolidation here, but then the very highest point that his stop loss is at took out all of the previous highs. So that is, to me, the differentiator, because that's what shows a liquidity sweep at the end of the day. If there was no sweep of a high like this with this high volume bullish candle, I would definitely sit out of this trade. But I like how we have the consolidation, very high volume grab of it, and then a break. So solid trade in my opinion, good break even. And then this one, I think this is a great trade as well. So we have that very high volume bearish move and then the bullish move right after that, following a very clean trend. You could see we even took liquidity at this relative consolidation area here. We reached right below it, grabbed that liquidity, broke higher, and then we have a fair value gap right at that entry level. So it's a great trade in my opinion too. Another great one. So we have that bullish trend again, a very high volume and impulsive bearish move. This is the key. I use these words so much, you guys probably get sick of it, but high volume, impulsive, these words that I use really show, fundamentally why we trade this plan. I said this in chat earlier today, but we're not meant to be pattern traders. We're not meant to be people who just see, a head and shoulders pattern and you enter the market, or an equal top pattern and you set your stop loss kind of like retail does it. Fundamentally, the bottom line of this trading plan is to align ourselves with institutional involvement on the 4-hour time frame. And institutional involvement in the foreign exchange market is very clearly shown by volume. The foreign exchange market alone has $7 trillion per day in this market. That means if everybody in this community took our money combined and put it on €1 US dollar trade, we wouldn't even move the market. It wouldn't even move a pip probably. It is one of those things where institutions, these very overcapitalized institutions that have millions, if not billions of dollars per day to throw at this market, is what we're looking for. You want to be with the big fish. You don't want to be, trading with the little guys like us. You want to be focused on what the large scale, high capital institutions are doing. And the only person that can move a market this impulsively bearish and then breaking structure in a high value market is people with a significant amount of capital. A candle like this does not form by accident. A candle like this with very high volume is super, super intentional, clearly grabbing, relative triple equal lows here. At the end of the day, these high volume movements are to grab liquidity, grab orders at rest in the market so that institutions can then drive price where they need it to go, which would be this next liquidity point high. Think of it if, we were a bank at the end of the day, simple markets. If we had a buy position on a higher time frame, keep in mind, these institutions are buying and selling all day at different levels. But if we had a large scale buy position on a higher time frame and we needed to drive price higher at some point, or even to this liquidity point here to then drive it lower, it becomes a matrix of just where the most orders rest in this market and how I can use that to make money. If I wanted to make money by driving price towards this liquidity point, I would have to grab a bunch of sell orders, which rest here, because, at the end of the day, these are your stop losses. And if there's a bunch of stop losses below this low, those represent sell orders in the market. And if you drive price through sell orders, now all of these sell orders have just entered the market for someone like me, a big institution, to go in and buy all of those orders. Because once again, I can't place $1 million buy order if there wasn't $1 million of sell orders at that level. They grab those, convert those to buy positions, and drive price higher, making money in the process. They're basically taking money from the uninformed traders. I hate to say it, but that's how these markets work. Once again, if I wanted to make money in a short position, I have to reach a point in the market where there's a ton of buy orders so that I can now convert those to sell orders. If I wanted to place a $1 billion buy order right here in price action, I might not be able to do it because there's not enough people who are buying the market at that point to buy my $1 billion sell order. So I would have to drive price to a significant high or low. This is where a lot of people are likely having their buy stops or their stop losses resting. So price is driven up there. Now a bunch of buy orders have entered the market. So I'm able to go and place that heavy $1 billion sell order that I'm aiming for. Obviously, this is all hypothetical. I don't have $1 billion for sell orders, and this is not really what a day-to-day trader does. But on an institutional level, this is what they need to do. They can't place their huge scale orders unless they have the liquidity and the opposing orders to do so in the market. Big tangent there about liquidity and fundamentally what it is, but I just, it's a great example of it visually, and I think it's super important for a lot of you guys to remember why we trade this plan. It's not meant to be a pattern. It's meant to be an actual, system that follows or aligns ourselves with those higher time frame expectations of institutions. This one's not a bad trade either. I like this one a lot. I like the impulsiveness of the sweep. We grab this relative liquidity low here, big or small, we break structure to the upside. I do think it's a little bit tougher regarding consolidation, but he mapped out structure very, very well here, so it kind of helped him clean out the muck a little bit and focus on just his high volume areas. So you can see we have the higher highs and higher lows. This low should not be invalidated. This high is going to be his target. Now that we took that, this becomes the lower low, or sorry, this is your higher low and your higher high. And he had this very high volume area that most recently broke structure. It was a great setup there. Let's go down. I think I have to load more. I don't know how this works. Oh, there we go. Another solid setup. Does kind of fall into that category of consolidation we talked about a little bit. There's a bunch of relative equal highs here, but as you can see, it does work out in some cases, so not a bad setup overall. And I do like his position here, but kind of the same idea, this past one here. So we have a bunch of wicks thrown at these lows here, a bunch of equal lows, and you can see that if you don't see a good liquidity sweep, you likely are the liquidity. And we can kind of see that here where price just comes right below all of these lows so that they can convert it into those buy positions they need and then driving price higher. So your stop loss ends up getting taken. So having your stop loss at a little bit more, high volume impulsive areas could definitely help. But I think regardless, I do not need to go through much more of this data set here. The data is fantastic. The edge is clearly there. And my best advice for you would be take this sheet, use it like your holy grail when you get into a live market. Every single setup that you're seeing here, all these pictures, super, super important. Continue to look at them when you're in a live market and use that as kind of your blueprint for profit. I think with this win rate here and the amount of trades you're taking, this is a great cadence to the strategy. 250 in a year is very solid. I would just take this and do your best to replicate it in a live market. I would definitely maybe open a demo account if you haven't already. You can backtest and use a demo account, but this is fantastic data. There's nothing much really that I have to go over here. We can go over another one here. Let's go back over here, and then I will check that one off. And then Leo. So this is Leo's first 100 trades. So he's also new to the server. So I do want to, what time is it? Okay, damn, we're running out of time here. So I was gonna say this one would definitely be a little bit of a deeper dive because he is brand new. So I might go ahead and do this one personally, and then I'll either talk to other coaches or we'll get these 3 done. But I won't be able to fit it into the webinar today, unfortunately. So I'll have to do this at a separate time. Any questions that you guys have for me regarding setups that I might have, anything that you're looking at, if you want me to look at some of the trade expectations that you guys have, anything like that. Let me clear some of this out. I had to get rid of all my colors on my watch list though, because I downgraded the trading view plan. I felt like it was useless, so at the end of the day I didn't really use. I think some of the stuff that you get with it is like multiple indicators, which I really don't. I have this one just purely for cosmetic. I barely use any indicators. And then I think you could like color the list, which also is something I really did not care for. So I ended up getting rid of it. I think I've had it for 5 years. I think I've had the TradingView subscription. Not much else that I'm looking at. Any setups that you guys have, let me know. I'll check them out. Euro USD short. Euro Chef, I'm in that one. USD Chef, that short was pretty solid as well. I missed it, but I like that short. We'll look at NZD CAD and then we'll look at Euro USD short. Let's look at NZD CAD first. The buy position, I'm assuming right away I can see from here to here, it's a pretty solid setup. This one's kind of tough because the range here too. We're kind of working within an ugly range on this pair. Like even if you go to a higher time frame, it's kind of something that you can't really see too well. The only thing I would say is we're definitely a little more bearish than bullish, but a trade like this is more than viable. So I think that's a good setup. Let's go to Euro US dollar now. I'd assume it's a short position here. I like this one as well. We swept the liquidity of the high like this. And then we broke structure to the downside just now. And then we have a fair value gap right around that general entry level. So I think that's a solid setup as well. Some relative equal highs at the high there, but I do like the liquidity that we took here. We have a very significant high in price action. We came above that to take those orders and then broke down after that. So I think that's a solid setup as well, actually. Any other ones you guys are looking at? And then obviously I have Euro Chef already myself. I'll give a few more questions in case, or a few more minutes in case you guys have any more questions, and then I'll try to wrap it up here and get this posted. Any others? Not really, but you know, I do my overview typically on Monday, like a big overview of all my pairs. So not much else that I'm looking at. I'm in Euro Chef right now because obviously Friday's an odd time for a webinar because I don't really do like a deep analysis on every pair and set my orders on Friday. I tend to do that on Monday. Sometimes even Sunday I'll do it and kind of get prepared for the week. But yeah, nothing else I'm really looking at now. But if there is anything I come across on Monday when I do like a deep analysis of every pair, I'll send them. I gotta get better at team trade. I always send them in main chat. I'm just so used to doing that because it's like the chat that everybody's in. Getting used to send them in team trade. So I'll do that this Monday. Thoughts on Euro GBP? Let's check that one out. Also not a bad one. I think it kind of goes into what I talked about consolidating for the lower high. Having your stop loss at a lower high that is a consolidation area. But I think the important part here is that we did come to grab that last significant high in price before the break. So I think that's a solid setup. And I love the fair value gap right at the entry here. But yeah, I think that's the key to me is like that last sweep on liquidity, grabbing that lower high before the break. We can see how high volume that break is as well. So that's a solid setup too. Euro GBP. All these are pretty good. I might check some of these out when I go through my pairs on Monday. All right. If that's all for questions, then I might wrap it up here, and I should have this posted within 10 minutes or so, as usual. Let me make sure no other questions roll in. If they do, obviously, you guys can always DM, or I'll get to them here. No problem, guys. Thank you all again, and enjoy your weekend. I'll catch you guys next week.